Welcome to Dr. Fred Markets. This is not financial advice. While most people ignore what's happening in the markets, a few choose to pay attention. And that difference, that simple choice to stay informed, changes everything. You're one of them. Let's get into it.
Sports betting is the only honest stock market left. The Knicks just won their first title in 50-plus years. Madison Square Garden stock barely twitched, and the S&P keeps grinding higher at 0.5% a day, like a medicated patient. Capital isn't in teams, it's in the bets on teams. First signal. Global sports betting revenue runs over $200 billion a year, growing faster than the actual leagues. DraftKings alone just pushed past $20 billion market cap, trading richer than a lot of serious industrial names that actually make things. The house doesn't play the game, the house sells the action. Second signal. New York just turned that Knicks title into a tax meter. Legal sports betting handle in New York topped $19 billion last year, with the state ripping 51% tax on operator revenue. Your parlay is now a muni bond without a prospectus. The government takes its coupon before you even touch a payout. Third signal. While the media drools over dynasties, smart money now prices attention liquidity, not championships. The Knicks win barely moved MSG stock, but betting operators spike on volume surges when games go wild, overtime hits, or superstars choke. Drama prints cash flow. Steady excellence is actually bad for business. So here's the cliff. You're still trying to own the team, while the real money owns the spread, the VIG, and the data fire hose behind every bet. You're funding casinos with Fandom while pretending you're an investor. Let's connect this to the market you ignore, listed sports betting and data companies. Not the shiny teams, not the jerseys, the guys selling the digital chips. Earnings are basically a clean math problem. Handle, hold, churn. Better deposits in, tiny edge skimmed out, repeated millions of times. That's not gambling. That's industrialized microtaxation on human emotion. The mechanism is brutally simple. First, attention converts to handle. Big games, scandals, miracle runs, engagement turns into dollars at the app level. Second, hold rate. Books keep roughly 5% of handle over time. Wild swings, crazy upsets, the stuff fans live for. Just fuel volume, not risk. The bigger the circus, the fatter the rake. Third, retention. Same user, same credit card, infinite spins. Now compare that to your index fund. The S&P at 0.5% a day is a polite glide. Sports betting revenue doesn't care about GDP prints or Fed speeches. It cares about schedules, narratives, and your cousin chasing a sure thing on Sunday night. Correlation to macro stays low because addiction doesn't read CPI reports.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
Here's the part nobody says out loud. The more chaotic the world feels, wars, political mess, whatever, the more people retreat into sports and bets as controlled chaos. They can't fix Congress, but they can hammer the live line on Knicks versus Celtics and pretend they have edge. That psychological need is a business model, and the public markets now let you buy it. Actionable takeaway, because we're adults, stop thinking in teams, think in rails. If you want exposure to this attention engine, you look at 1. Regulated sportsbooks and platform operators with scale and licenses in high-tax but huge states like New York. High tax sounds ugly, but it also keeps new competition out. Moat by bureaucracy. 2. The infrastructure layer. Odds providers, data feeds, risk management software. They sell picks and shovels to every book, plus analytics back to leagues and broadcasters. Lower headline risk, less regulatory theater, still tied to the same growth curve. 3. Media and streaming partners that weaponize lives on screen. The future isn't ads around the game, it's odds embedded inside the game. Every possession becomes a trade ticket. And risk, because you're not 19 anymore. This is regulatory catnip. Politicians love protecting problem gamblers while extracting more tax. That can crush margins if you buy junk. You focus on balance sheets that survive higher compliance costs and marketing caps, not momentum tickers sponsored by ex-athletes on billboards. This is not financial advice. It's a reminder that your parlay is someone else's dividend. And right now, that someone else is mainly the state and a handful of very focused platforms. So here's your 3-point summary. 1. Championships make headlines, but betting volume pays the bills. Leagues are the content, books are the business. 2. The real asset isn't the arena, it's the regulated funnel that turns fan emotion into recurring, high-margin revenue. 3. If you stay a pure fan, you stay the product. If you want to graduate, you study the rails. Who processes the bets, who owns the data, who controls distribution. You decide whether you keep tipping the house every weekend or whether you start treating sports as another uncorrelated cash machine inside your portfolio watch list. Hit subscribe if you want brutal math instead of fairy tales. And remember, your team doesn't care about your bankroll, but their sportsbook partners absolutely do. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.